As we've been telegraphing to our clients over the past number of weeks, we really think that the bear market has really only entered the second stage here over the past number of weeks, call it a couple of months or so. And what we tend to see in the second part of the bear market is much more a focus on economic growth slowing and ultimately credit problems. And I'd like to show you a couple of charts here that it relates to consumer credit, particularly credit card debt, that is a lethal combination with higher rates. So let's get to this quickly here. Again, we think risk assets are going to go lower again here in the second stage of the bear market. And to give you an idea on this, if you look at these two charts, start with the left-hand one first, you can see that consumer credit, which includes credit card debt, is now back above the trend from the pre-COVID levels. And if you combine that record amount of credit card debt with now multi-decade highs in credit card plan rates, that's a big problem. And these are the problems that usually really get to the real issue of the bear market, where people ultimately start to capitulate and the market goes quite a bit lower. And that's where I think we are. Now, we could draw a very similar comparison in the corporate debt market or even private debt markets, like private companies or public debt and private companies, excuse me. It's a similar issue, record debt. In fact, it's almost the same exact issue, record debt and higher rates, and more people have to refinance at rates that they never thought they would. They basically have no more business case. But for the consumer first, because I think a lot of people have an easier time understanding or getting their head around that. Think about before COVID, we had credit card debt somewhere around 12-13%, which was below where it was in the 90s, to be fair. Then during COVID, around 15-16%. We're now at 19 and rising. Combine that with record ever credit card debts, and this sets up for a big problem, and we think risk assets go lower. It's going to be more and more difficult for people to make directional bets. So if you're focusing on trying to generate an income in the market and you're trading charts breakouts, which has stopped working a long time ago now, what we do, we use options in a very specific way to generate income where we don't have to be directionally correct. And I'm going to show you guys exactly how that works. We also use a specific tool that I can give you to do that strategy as well, if you'd like. And we're going to do a webinar this week and show you exactly how it works, why it works in our free research call this week. You can sign up for that down below or on the next screen. We'll see you there.